Okay, everyone, hold up. Let me just go ahead and fix my camera a little bit. That's why we had a little bit of a longer intro today. I believe this works. Okay, there we go. Yeah, so I was cutting it close a little bit because I was updating the camera while the intro was going, and I was like, we'll have to do a software update. So I had to, dust off as they say, the YouTube password. I saw a comment saying in the last video, it's like, oh, you just remembered your YouTube password. It's like, yeah. It's been a while. All right. So we got a lot of topics to cover. And so I gave myself a 5-minute leeway. So we just passed it for the intro. So all that was the intro. So the first thing we're going to be talking about, I guess we'll go over like broad market news and sentiment that's kind of plagued everyone's mind. I don't know why this is. Oh, by the way, I'm wearing appropriate attire for today because we're going to be talking about Lululemon. This is one of their cheaper competitors. And we'll talk about like the differences in quality, and I brought this one out for that very purpose, to kind of talk a little smack about it. But and you can see the brand. Oh, wait, the brand is right there. Does the camera not show it? There it is. Yeah, so Fabletics. So this is their cheaper competitor, but we'll get to that with the Lululemon. Okay, so right now I just have S&P 500, typical Vanguard ETF out, ticker symbol VOO. It's up 1% today off of some, you could say, seesawing action or promises from like the peace, no peace with Iran and Israel, and all this geopolitical tension that we're supposedly, experiencing right now. If you go on Twitter, and I don't really understand why this was the case. I was talking to the members about this. It's like, why is it that all of these people on Twitter are talking about, WW3 and all these other things? Like, it's all bullshit kind of fear, trying to, I guess, stir up content, remain relevant in some capacity, relevant in the sense of just trying to grab eyeballs, because, for the most part, FinTwit is not about actual production of alpha or returns. It's just about sort of just getting people to look at your stuff and then maybe selling a product on top of that. So yeah, when we look at really the changes that's happened to the market, nothing substantial has happened. So that this segment is just going to be kind of a boring and classical, saying nothing ever happens sort of meme. The discussion whether or not Iran conflict with the United States has any sort of relevance is, I think, moot at this point. The only concern that I think is quite valid is its effects on energy, and then how energy then trickles into the broader economy. So we've talked in the past, right, about how energy prices were down, and that brings down the input costs. So it makes it a little difficult for you to really see some sort of strong or persistent consumer weakness, right? And so if that goes away and you have energy prices starting to spike, let's say past $100 a barrel, for example, well, that whole argument that I outlined goes out the window. And now we have potentially a greater possibility of a recession. And I guess that's the only point at which I think is valid. There were others who were going a little carried away and saying that this is the beginning of this like massive conflict, when it's like, no, Iran, in terms of relevancy beyond its acts of terror on various enemies of themselves, it's sort of an irrelevant country. And I know it's like, that's very crass of me to say, and I always was telling the members, it's like, I know this is going to sound very crass and very cold-hearted, etc., but it's the truth. You can't really get around it. Omega Bright on this, Omega bricked on this war. And then so we are actually seeing a bit of a pullback here on some of the defense stocks last I checked. So NOC is down 3.29%. We're actually going to put them all side by side here. Lockheed Martin's down 2.6%. L3 Harris down 2.13%. Although L3 Harris has actually had a great year so far. Even Boeing's a little flat today. General Dynamics is barely down, but really the big three that I've spoken about in the past. Oh, let's check out HII. Just throw them in here. Oh, I don't want any of these. Huntington Ingalls, okay, also down 2.29%. So I'm actually quite surprised. Oh, let's look at Leidos. Let's put Leidos in here. All right, Leidos is barely down as well. So General Dynamics and Leidos barely down, with L3, Lockheed, Northrop leading the pack in terms of losses here today. I viewed the defense trade as perhaps like more of a early 2025 ordeal, not so much a Now they're approaching more fair value. You could say Lockheed still has some debatable value left in the tank. There's a lot of concerns about, of course, them not gaining the new dogfighter, and it's just sticking to the F-35 program. Although the F-22 wasn't that much of their total sales at any given year, it was already sort of being phased out. But that is a boon for Boeing, so it's going to be a little bit of a boost in the medium to long term. We already have a video pitching Boeing with one of our special guests. It was recorded before Boeing actually rallied to 200. Boeing then proceeded to rally. Let's actually bring up Boeing stock so I can show you the price action. So Boeing actually is having a little bit of a pullback here, but it went all the way close to about $220 before coming back down to 200. I won't bear the lead here. I think Boeing on this pullback is actually kind of interesting. So people are underestimating the commercial side of the business actually coming more meaningfully back online, the cap being lifted. I've done collaboration content with Dan Weston. Dan Weston's talked about, of course, the labor union deal as actually being something to look out for. When it did happen, that's when he changed to being more bullish. And you can see the performance since that agreement has actually been quite stellar. And then, of course, the opportunity that presented itself during Liberation Day sell-off when everyone lost their minds. I call that, one of the great wealth transfers of 2025 from the people who have stomachs to those who, from the people who don't have stomachs or lack gut and maybe are a bit too emotional to the people who can be or act a little bit more calm and collected about things. So it's unfortunate how that works, but it is how it works. So the other topics that we're going to get to, and I have them all down in the description. Next, we're going to get into recession. So I don't want to overlay this topic too much, but Iran and geopolitics does sort of connect to that in the sense of, energy prices and what the effect it might have. So what we saw in the most recent news, of course, is, this claim by the president saying that Iran and Israel came to some sort of terms on a ceasefire. To the last of my updates, and things could change because things are moving really fast. So as I'm recording this, things might be changing. The chat might be saying, no, that's no longer the case. But as of my last update that I recall, the ceasefire looks like to be teetering on collapse. One side or the other is claiming that the other one didn't abide by it, and the other one supposedly attacked in the midst of the ceasefire. And so the market doesn't seem to care. And personally, like I said, what I was iterating before, I don't think you should either. I think that for the most part, I know it sounds like very insensitive, but they're not irrelevant place. So the effect on what it will do to business earnings, unless oil or energy spikes a tremendous amount, is to the point where you can just sort of like ignore it. Has it changed anything fundamentally for most of the businesses you probably invest in? Probably not. If anything, that's what I was telling one of the members when he was asking, like, they're going to be sell-off on Monday. I was like, if there is, it is a tremendous buying opportunity. And I think we had a very brief sell-off before it just like continued rally. And yesterday was not the best day of the year by any means, but it was a pretty good day nonetheless. It was one of the better days. And then today also, well, depending on what you're invested in, today's also seems to be a very good day as well. So every ceasefire in history, I give it 3 days max. Okay, I'm not going to get into like politics or anything like that, but yeah, you're welcome, everyone, to share your opinion in the chat. And I did every question. Yep, nothing ever happens. Every question I will try to star, and I'll answer in the Q&A section. Okay, so thoughts on NVO hymns. I'm going through and starring some. So if you ask your questions, I'm starring them for the Q&A. Okay, and if it's a question that pertains to the topic, I'll answer it right now. By the way, it's not like I'll wait for that to the end. Did we really think it would be peace overnight? No, I don't think anyone really thought that. But I sort of just view it as like a nothing burger. Like I was saying, it's not really affecting the way I'm investing. There are other things that are far more important than something going on, between Iran and Israel and the United States kind of coming in. Because to kind of illustrate the point, one of the late members one of the few members who were actually banned from CF. I remember having and I'm friendly with the person. They were banned for reasons of breaking the rules. So if you're watching this, there's no hard feelings between us. But they were banned long ago, and one of the debates we had was like the actual military capacity of Iran and that of Israel. And I was of the position that Iran was a paper tiger, similar to the Russians, and that the Israelis would have no problem, stomping over them. And that's pretty much exactly what happened. So if you're watching this video, I'm not going to say I told you so, but I did tell you so. So yeah, I am telling. I told you so. Okay. Any changes to the data center? Okay, good. I'm going to star this. I'm going to star this one. If Biden, okay. Oh, this one I can answer now. So if Biden did the strike, would the media try to freak people out less? I'm not gonna like dodge the question, so I'm just gonna give you my honest opinion. Probably not. Probably not. Well, depending on what portion of media. So like most media, in terms of like mainstream, because there's alternative media and then there's mainstream media. So alternative media, probably not so much the case, and I think alternative media has grown higher in prominence, so it has a greater impact and or effect on the populace than before. But mainstream media, yeah, tends to have an overwhelming dictation to a particular viewpoint, and probably I probably stand to say, because something similar can happen to, which again, like it's not like I thought it was that big of a deal, right? It was a big deal, but I didn't think it was that big of a deal. Was the departure from Afghanistan? Like again, like I said, it was a big deal, but that was maybe more highlighted by alternative media and or like in the mainstream media, the Fox News, but was not buried by the other mainstream media, but wasn't like as highlighted. Like you can look at third-party services like Ground News, for kind of like that idea or depiction of like what's being covered by what, etc. So yeah, I'd go there to try to see like an emphasis, like plug. I'm not sponsored by them, but that's like a free plug there. Iran is still flying F-14s like Tom Cruise. So yeah, this is for the conversation or topic that they were a paper tiger always. And right now it's kind of funny just to watch it. Funny and not like a legit funny sense, because I know it's like war, it's sad and stuff, but in the sense like they talk so much smack, and yet they just kind of have to lay down there and take everything that's been given to them with like very paltry amounts of like a retaliation that frankly is having like some little, in terms of, if you look at casualty percentage and potentiality, it's very low. And I'm trigger warning to all of those who are like, oh, it's so insensitive. Well, this is not probably the channel. So if it bleeds, it leads, and hype it. I don't know what bleeds and what leads and what's being hyped. Okay, so I think we can move over to the next point of discussion. I'll leave like a couple more seconds for any questions pertaining to this topic. Okay, we have travel stocks. And you know what, fake alias, that actually is pertinent to the next topic. So we'll kind of use this as a segue. So the next topic we're going to be discussing is recession no longer in question. And that actually relates itself to travel stocks. So airlines. Airlines, no secret, it's a popular opinion to not be big fans of the airline stocks, but let's try to be constructive about it. So United Airlines has had this trend towards premiumization. Southwest Airlines has also been cutting back on some of the more free or included products, trying to also focus on premiumization. Premiumization is the trend across the entire category. I think that when you're looking at airlines per se, you have, of course, the travel volume, but also the reward system and the desire to participate in that reward system is probably the most important part. So what I mean by that, there's a bunch of free business breakdowns for you guys to look up. It's actually one of the things that you may or may not study in MBA school. And you learn a little bit about what the part of the value chain for an airline is the most valuable portion. And that's, of course, like the reward system, the point system. So it's not as much as you might think the actual travel in the tin can from point A to point B. It's more about bringing someone into this like ecosystem, the credit card reward system, and then you're swiping cards for points, et cetera, and then they're selling the points to banks. So that's where a lot of the money is made. Of course, one relates to the other and they feed each other. So if it's a popular airline, then it's going to be more likely to have a more desirable reward system and point products. But yeah, United Airlines or the airlines in general, all moving towards premiumization. I tend to not favor them. This is, again, not an unpopular opinion, but Booking, probably the best play in travel, along with Expedia. Expedia is less loved. Expedia it's a little bit more of a, okay, that's a little bit of a fail. There it is. I don't know why it wasn't letting me, but Expedia, short Google on that. Expedia is sort of like this US centric, US focused travel player. They're a little bit different from Booking in that they are Booking, for example, I forget the exact vocab word, but Booking doesn't take the money until, for the most part, doesn't take the money until you actually stay at the location, while Expedia does, like, you pay an upfront. Well, they do both, actually. And again, I forget the term it's used in the industry. But there's a little bit slight difference in the business model, which does lend that Booking's margins look a lot better than Expedia's. Although at the end of the day, I personally would just focus on like the raw earnings power and the growth on that. Expedia has grown slower than Booking. Booking has shown tremendous aptitude to grow in the alternative accommodations. Expedia has struggled a little bit there, but Expedia has actually grown quite interestingly in the business to business travel expenditure. So it depends on like really what you think is going to be the better play moving forward, because they're roughly the same. They're just focusing on different parts. And of course, like these are both businesses that I think artificial intelligence will have a positive impact on efficiencies moving forward. There is an argument some people make that a lot of these companies will be disrupted in the future. I don't really know entirely how true that is. Of course, throwing Airbnb in there as the king of alternative accommodations, their newest product, which was hyped, I really don't think it made much of an impact, because it felt like it was something they were already offering. So I didn't really see anything of value there. So, kind of a disappointment in my personal view. But yeah. Okay, so that's what you meant, Hans. If it bleeds, an old TV newspaper formula. Anything bleeds, destruction bleeds. Okay, yeah. That's a good saying, though. Yep, UAL is starting to do buybacks. So yeah, a lot of the airlines are attempting to, pad up what the damage they've done to the share count over the past couple of years, ever since COVID. So COVID happened, and then you had massive dilution from many of these airlines. I think the one that was least dilutive by far was Southwest Airlines. This is the airline that has typically always had the best balance sheet of the group, with a net cash position, and has also been one of the most rewarding to shareholders over the past decade or so. And right now it's hated, right? So compared to the other airlines. So if there was one I wanted to do more research on, it'd probably be Southwest, to try to figure out why is it so hated, why isn't it in the penalty box, and why are the others at seemingly a much more rewarded valuation. That PE ratio, of course, you always have to investigate that further. It looks suspiciously high. When I recall, not even too long ago, the PE at a higher price was much lower. So there could be a lot of restructuring costs, one-time expenses, et cetera, that you want to smooth out and figure out what the actual business is earning. Maybe you kind of go up the income statement to an EBITDA and start to see like what the operating earnings are of this business. Okay, circling back to the whole talk about recession, this is more of an update to the prior live streams that we discussed. The risk of recession and where it all comes from the consumer, what the banks were saying, and I think that's slowly being put to the side. And more investment banks are coming out and changing their view. It's funny how that works, right? Because they were all like, oh, recession. And now they're sort of switching back to the sidelines saying, okay, like we're unsure. And then some are saying probably low probability of recession. And if you just listen to the consumer banks which have probably the best pulse on the consumer, and then in the United States in particular, other countries as well, the consumer is the vast majority of the overall GDP. And so when you're trying to measure or predict where the economy is going to go, you really have to focus on one thing really, and that's the consumer. We have probably had a recession in a lot of the industrial space, and that might be coming back. We still are, according to the truck companies, they are in a recession, a truckload recession. So, think of Old Dominion Freight, Ryan, all of these, they're in a recession for going on, I think, 3 years now. But that doesn't necessarily, and this is the problem with that. They likely were over earning, and I can actually let me go ahead and bring this up. So if I bring up Old Dominion, and I'm going to use let's go to the financials and bring up sales. Okay. Okay, and as you guys know, I have a sponsor. It's down in the description below. I don't take sponsorships unless I actually use the product for quite some time, and this is one that I have used for quite some time. So it's made it into the sponsor list. So if you're interested, down in the description below. All right, but anyways, so Old Dominion Freight Line, right over here. You can see what I'm going to highlight to you is look at that period during COVID when you had this massive, massive run up. So this whole crying about being in a recession, so to speak, is arguably this whole like retrace to a more normalcy. So you had this massive pickup in growth and profits. If I were to take profits, you'd see the exact same effect. Of course, like now let me remove sales to show you the same effect. So profits also jump. So what is happening here? Is it really some sort of massive contraction, or are you just returning to some sort of normalcy from before? And so that's like the color they don't add. And if I played a game with the members, I went into Old Dominions and I just like went through the past earnings calls of like the past 4 years, and every single one was like doom and gloom on like consumer and stuff. And yet here we are. The same thing you can do with Walmart. Walmart's been saying the same thing for a long time, and there's like nuances that as to why they don't have the full picture. And in reality, who's going to have the fullest picture is consumer banks. So you want to listen to what Walmart and like, for example, Target would say, but up to a point. In reality, who has the best data is going to be the consumer facing banks, who have all of your credit card statements, your checking account statements, savings account statements. They know what your P&L looks like, or the average P&L looks like. And so their words, in particular, some names I can name as the largest, I guess, emphasis, Bank of America, which focuses a lot on that upper middle class cohort. And then you also have to consider the following, that if you break down the US population, the bottom 20% contribute nearly nothing to overall consumption. And then a lot of the consumption, and by the way, every country is like this. In some countries, or many countries, is actually worse, the disparity. But in terms of like actual consumption, the upper echelons are actually contributing to most of the consumption. And this is, again, true in almost every society that you look at. And in some, it's like even more sparsed out. Or sorry, not sparsed out, concentrated. So for the United States in particular, I'm just saying that for that one, the bottom cohort, for example, the Dollar General cohort, they're contributing nearly nothing to the overall consumption, and ergo, their consumption is not of material matter. I know, okay, if you're insensitive or you feel like that offends you, not the channel for you, go away. But it's just what the data shows. So the consumption on their side, if they were to stop consuming tomorrow, as long as their labor is replaceable or replaced, there would be, in theory, no impact. So you want to just be aware of all this noise. And so, like, I'm showing you here an example of noise. Walmart earnings calls, when they say all that stuff about consumer, a lot of it's noise. Dollar General, a lot of that's noise. Doesn't give you that good of an idea. It's not to be ignored completely, but it's often used as like saying, well, look, this is what I'm going to use to predict the economy. And it's like, okay, hold up there. So I think better use is perhaps, again, like listening to what Bank of America has to say about the consumer. Chase or JP Morgan Chase, another one. But there's quite a few banks you can listen to that are much more consumer facing than not. Okay, so this is, I'm going to count as discussing the overall, like macro. Do you think that housing sector is going through a downturn and that could drag down the economy, especially with rising interest rates? So interest rates, oh, I still have your comment up. Interest rates, I think, are, I mean, they're fluctuating because I know that because of the, the fixed income I'm involved in. But I don't think, well, capital markets. So we want to separate, the treasury markets or the short-term markets from the capital markets. And so capital markets, yeah, they remain elevated for the time being. I think mortgage rates are pretty easy to find above 7%. So for the time being, there still seems to be a very strong appetite to purchase a home, but there's less and less quantity of people that can actually pay those prices. A lot of the people that can pay those prices, they're not wanting to buy a home because they're locked into a very attractive rate. So it's caused this like very strange lack of price discovery in real estate. And I feel this myself in my own market. And you might feel this in your market if you're in the United States. So this lack of price discovery is sort of this interesting phenomena that we're observing. Can you touch base on CPG companies are doing poorly? Yes, I starred your comment from earlier, and I'm going to be touching upon it. So I started this one just as an extra reminder. So that will be in the Q&A section. But yes, housing stocks that in particular that are showing signs of weakness. We'll talk about, for example, BLDR, which is a buyback machine, by the way. They actually moved up quite nicely with rising rates more recently. So you see this little pickup right down here. That was with the belief or the perception that rates were going to come down and we're going to start spurring housing again. There's of course Rocket Mortgage. But onto your question, what do I think about the state of the housing sector? It's definitely weak and it looks really weak. All the news points to doom and gloom. So off the cuff, because I got to move on to the next topic, I think it's interesting hunting ground for some opportunities. So there's Builders First Source, Top Build. I'm going to shout out Dan here with Master Brands. There's well, actually the other one's getting bought out, but QXO, which is basically Beacon Roofing. There's IBP, Installed Building Products. You can go for the builders, Toll Brothers for more like a cash buyer exposure. You can go for LEN, Lennar for middle income. You can go for let me think of a. Well, no, manufactured housing ones are you can kind of stick with those. But Lennar has a few peers that you can go through and figure out which one's interesting for you. But yeah, the supplier ones are the ones that are going to be most levered to that play or to that exposure. And then of course you have outside of that, the financing parts of the business, which is like the mortgage originators. You have PennyMac, Rocket Mortgage, Mr. Cooper that they took from me. Rocket Mortgage bought out, but that would have been the perfect play. And that was pitched last year for Capital Mindset. But yeah, those are like the adjacent plays that you could do for housing. Okay, so I think we're going to move on to the next topic, which is going to be Lululemon. So I have their competitor that I don't like as much, by the way, but it's cheaper. And so I'm a big fan of Lululemon. I've also started to purchase their actual closest competitor that's a bit pricier or more comparable in pricing, Alo. And then there's this one that I brought out, which is Fabletics, which is cheaper, still gets the job done. This is like the clothing I'll wear for, if I'm doing something that the clothing might get, more damaged or more beat up or stained. This will be the one because it's like the athleisure wear that I don't really care for as much. But yeah, there's competition. I'm just trying to bring up the point that there's competition. Well, Lululemon before attacked a vertical that no one cared to do. So you had Nike, but Nike was more of like the performance athlete and then sort of changed to more fashion, which because I think Nike shoes are terrible, or among the worst. And then you have Deckers that came out with Hoka. Hoka is awesome, or not came out. I think they bought Hoka, but Hoka, awesome product. On-Ons, awesome product. And then Nike's kind of meh. It's whatever to me. But Lululemon, they as a brand, I think. Let me start your question here. And yeah, okay. As a brand, I think still is really strong. Now, I'm working actually right now on a play with Lululemon. So I don't have a position right now, but I may have a position in the coming near future. So I'm trying to figure out what positioning I want to have as far as options go, and some sort of synthetic I might sort of create here. But by the end of today, I may actually, after this live stream, have a position in Lululemon. May, right? I may not. Okay. So, but let's talk a little bit about the company and so what's sort of happened here. So if I go to Lululemon, and I'm going to take give me 1 second while I get the valuation metrics here. So okay, so let's share this here. So you can see that Lululemon over this time period, it's trading at the lowest valuation ever. Now that in and of itself is not really the end all be all. So the question goes, okay, like what's happening here? Is something drastically changing? Now we're going to get some of the sell side aggregated estimates here, and I'm going to show you a little bit on actually I want to not take total revenue. We don't care about that. We're going to take the revenue growth rate. So what do you notice here? So I've sort of mapped this out to kind of give you an illustration, and I think it should be obvious, at least the trend. So if you've noticed that, hey, the multiple is actually going right in line with the growth rate, and then the expected growth rate. Now, again, this is sell side estimates. This may not be the actual growth rate. So you have to sort of come to that determination if the current multiple rewards you enough for that expectation on growth. And that might be what the market is expecting. The market may indeed be expecting, low mid single digits forward growth rate on the top line. Of course, now we're not discussing really the bottom line. Let me go ahead and get the bottom line here. So I can just go here and do percent change, and we can do here. So similar story on the bottom line. Now sell side may be incorrect here, but it's sort of like they put the net income margins being about the same, contracting slightly in here, but being about the same 2027, 2028. That's sort of, it feels like it's plug-in, right, from sell side in aggregate. But if they achieve some sort of efficiencies that you might be aware of, then you could have bottom line growing faster than top line, and then that multiple sort of makes more sense. But all in all, what you're looking at here is, I think, a clear story of the market was very infatuated with a company and then proceeded to lose its love over said company, just simply because the amount of growth you're actually getting from the business is simply declining. It's a more mature business. You have competitors coming in. So you have this one coming in on price point. You have Alo coming in on quality, and you have a few others trying to attack at the heels here and trying to take as much share as they can, because it's a very attractive market. Because what the value prop is, right, is you get the professional crowd who has a job or something, something like that, some little thing that people may or may not have, and then you grab the desire to both be presentable in the workplace. Well, this is not garb that's presentable in the workplace, but presentable in the workplace, and also would like to potentially go work out afterwards. So it could be used for both, and that's what athleisure sort of offers. So like there's the more professional side and there's the more casual side, and they have both. So if you go to Lululemon, they have clothing that's more casual, more professional, et cetera, et cetera. They have blazers, for example, that they sell at Lululemon now. So, but does Alo make your butt look as nice as Lulu? So this is not a question for me. This is a question for the ladies, right? So if you just go ask a lady and say, hey, which one does the following to you? All right, with that being said, we're going to move on to the next topic, which is a bit of an exciting one. And I'm going to be actually doing some collaboration content with Strongman Personal Finance in the near future. So that's a little bit of a shout out to him. So what is this that I'm discussing? So as the dollar figure of the portfolio has expanded tremendously over the years, I have also begun to desire to sort of like become a little bit cutesy with the cash accounts, so the savings that I keep to the side, and start to generate a bit of an extra portion of income that will support myself during a period of, in between jobs, retirement, etc. And so while the lion's share of my capital is going to be still invested in a total return, my current strategy as always, there's going to be a smaller segment of my capital, basically turning the quote unquote savings or cash pile into something that generates a bit more income. Now, the reason it's also dual pronged, and I think some of you, not everyone of my audience is going to find it interesting, but some of you, because I know what the age brackets are, and because I've been requested this, by the way. So this is also one of the things that prompted this little bit of an addition. It's not a redaction, but an addition of content. I have some older folks in the server. I have some older folks in the audience. I can see like the cohorts on who watches, and a lot of those people, not like the vast majority, but a decent amount, enough that prompted me to think about it, were asking me about, hey, like, thank you for the research and all the analysts do, but I'm approaching retirement, and I'm switching from more focused on total return, but now I want to focus on something that's lower volatility, etc. Do you guys, do any research on that stuff? And so that's sort of what is sort of happening, switching. I'm adding an additional sort of vector for me to see how I can handle this sort of capital and what kind of returns I can get. So the theory should go that this portion or this fund is going to have a lot lower volatility, and then focused on producing a actual spendable income that's above what treasuries can provide. And then nothing that, like it's going to be like a counter to the content on this platform with like yield max crap. So a lot of older folks, when they come on the platform, and you can see this in the audience profiles of these content creators that are just maximizing income to a degenerate degree, which I think is harmful. They're pushing a lot of these older folks that do not maybe understand the risks of those products, and are being sucked in by the idea of instantly making like 20% per year, 50% per year, 60% per year, and literally thinking nothing of it. So this sort of goal, right? And why Strongman's going to come in periodically to discuss content is because he is a tax professional. And then so we're going to make content talking about ways to strategize taxes, because that matters. And there's some people out there that think that doesn't matter. And it most certainly does, because at the end of the day, your spending money is the net amount that you can keep, right? And so that's why tax advantage accounts are so important when you enter retirement. And so if you have more disposable income, it's more important. And so for those of you who are not at that stage yet, and may still find it interesting, you're welcome to always watch those videos. I will be putting like sort of like a disclaimer of sorts in the titles, so what videos are what. I'm not going to create a new channel. That's not going to happen. So these are going to be like bonus videos here and there for different sort of kind of audience, and it's not going to be like what stock is going to provide the most returns, and so I'm also telling this to all the club members. So like the weekly content, etc., that I provide, or the private videos, those are all going to be the same. That's not changing. This is going to be more so definitely public facing, because a lot of those retirees, so to speak, trying to reach that audience, it's I think imperative that it's public, in order to try to steer them away from making potentially a very bad mistake with their retirement accounts. So there's ways to, I think, approach responsible yield. in any yield environment. And actually, right now is a really good time for fixed income investors to actually grab some solid yield before they change, right? And that's a speculation that they will change, but my hunch is that they are going to change. And so right now, it's a good time to start. So I'm starting out the fund, so to speak, with about just under $200,000. And then again, the goal is to look for tax efficient, responsible yield, lower volatility. And there's going to be some discussions of various products that exist out there that do end up providing that. And then there's going to be a modest options overlay, but it's going to be less discussed too much, but more focused on the responsible yield aspect. Okay, so talk about Dr. Latina being OP. Dr. Latina is a club member within the server. His name's right there, Alexandre. And yes, he is indeed OP. He is indeed OP. He actually has a lot of clout, especially recently with his ability to have miraculous TA. You know, and I'm not a TA guy, and you know, he's been pretty good. It's almost like magic now. So it's to the point where I think myself and the other analysts were consulting. Just like, hey, what do you think about this? That's a compliment to you, Alexander. I mean, I think you know that. If we're asking you, you know, hey, what do the crayons say? You know, that's definitely a praise of sorts. Okay, so if there's any questions about the income fund, you can ask it right now. But yeah, that will be sort of like a periodic update of sorts. And then when Strongman comes back, we're going to have those, you know, tax discussions. Again, those will probably be among the most boring content I've ever made. It probably put a lot of you to sleep when we end up discussing that. But I think it's going to be valuable nonetheless. And so I want to have, you know, YouTube videos out here talking about that. Okay. Let's see. And we're about to enter the Q&A section. Also, what do you guys think about the new intro music? So it's like, you know, Capital Mindset has different seasons. It's like we're on season 7. When start your club? What club? Oh, that's to Alexandria. Sorry, I thought that was to me. He has his crayon room. That's his office. The crayon room is his office. That's where he reigns supreme. All right, let me see. I got this. Was gooning to the intro. Okay, so I think all of you. No, I have them all. So I'm going to be mixing and matching. Don't worry, the old anthem isn't gone. But we're gonna have a mix now. So as long as it can get down into the intro. How am I tonight? I'm doing pretty good. I'm encoding, so I didn't hear it. Oh, okay. Well, you can hear it later, Fuhan. All right, so we're gonna enter the Q&A section a little bit early. So the first question I received is thoughts on MVO situations with HIMS. So I'm going to be honest, like I have not been, and I've been asked about HIMS before. I'm not a fan of HIMS, but that, you know, it's just not for me. I tend to not like the retail stocks. Everything that's like retail loved, I tend to shy away from. I'm just not attracted to it. Pun intended with HIMS because it's the boner pill company. I jokingly say that the bulls are gonna be like, it's more than that. It's more than that. So, yeah. Oh, this is a good question. So I did, and I fumbled the bag hard on this, Cal, because a lot of times. So there was a really strong opportunity. We talked about it as a pitch in Capital Mindset. And the originator who put it on my desk, he held it. So he definitely benefited from it. And there are a few members who are more in the precious metals camp. They're constantly analyzing. They have their own room where they discuss precious metals opportunities. But this one was one that I sold way too early, and it's Franco Nevada. So I'm going to almost like do like a soft elevator pitch to you guys. I mean, it's too late. Oh, arguably maybe not too late. I don't know, depending on where you think precious metals are going to go. But there was a tremendous opportunity in dislocation and price with Franco-Nevada and the other players. So you had S-class management team, S-class capital allocation, everything. What was going on was this mine in Panama that was bringing all this like fear and uncertainty onto the company. And there was a huge opportunity to buy in at a discount relative to peers. And just like on that basis alone, you would have done actually really, really well. And this is jokingly, but literally a company that just collects checks. So if you've never heard of this company, put it on your radar. So I see Cal already knows about this company, but everyone else, put this company on your radar. If there's ever like this sell-off, look at them. And I think the other one's Wheaton. Wheaton Precious Metals. Those two are among the best. They're like the blue chips, so you won't really see a lot of periods of a major sell-off, but you had one, and I fumbled the bag hard. I sold too early because it kept running. And I participated in nearly none of the overall uptrend recently. So that was quite unfortunate for me. So there's definitely fumbles. This is a fumble. This is an example of a fumble. But great company. Not mad at the company for doing its thing and rallying after I sell it. It's like the meme. Sold it. Boom. It's gonna rally. But I don't have a constructive opinion on precious metals right now, although I do have I think I have a somewhat of an opinion that I can share on commodities in general. So it's particularly oil. So I have been purchasing here and there BSM, Blackstone Minerals. So this one's a royalty company. I'm also been looking at Viper as well, Viper Royalties as another one. So that's ticker VNOM. So Viper Energy. Both of them are royalty businesses that focuses on oil and natural gas. Viper is structured as a C corp. They transferred their structure, I believe, in 2021 or 2022, and then BSM is still an LP. So just keep that in mind. You'll get a K1 with BSM, and you won't with Viper. And so for international investors, you may prefer Viper. So hope you guys are enjoying the fact that I have a nice repository of tickers in my head. Endless repository of tickers, constant memorization of new tickers. So like I think another one that I was constructively bullish on was Repsol. And then this is Alexandria. I mean, in our discussions, like this is one I regret. I did not re-add right around this area when we talked about it. But this is another one. This is I didn't mean to do that. This is interesting story, weird story to say the least, like terrible chart. The business is going through a complex restructuring. I don't really like it, particularly at this price. I liked it more when it was in the 12s and below. But at 14, some of the optimism is starting to get priced in. I think it's still relatively cheap, but you have a wait and see story there because they're transforming the business to more of a utility using the cash flows from the legacy energy business. So that's not without risks. So you don't want to, I mean, it could work out. Like you buy it here, they got a nice buyback, they got a nice dividend. Like it very well could work out. I'm just saying that relative to the perceived risk with commodities, I want to maybe be a bit more cautious. Now, oil it came down yesterday because there was this almost consensus trade that oil was just going to shoot up. Looks like that sort of died down. And I was, like going like, no, don't rally yet. Because typically like some of the commodity guys in the server, like they've explained to me, for example, their rule of thumb is like, they want to look for companies that tend to have a good unit economics when oil is at 60. And so if you find those and you allocate your energy portfolio to those kinds of companies, theoretically, you should do better than the overall average. Now, that being said, in depending on the periodicity you're looking at, companies that have a leverage to higher oil prices will do better in those interims where you have energy moving or stepping up by a crazy amount. So just keep that in mind. Wow, as we're talking, the Qs are up almost 1.4%. So I can't believe what my portfolio is looking like. Thoughts on FRU? Let's look at FRU. Freehold royalties. I have not looked at this one, but Canada has a ton of royalty companies. I gotta look at like what this one focuses on. Let me go onto their website here, and I can sort of see quality assets, freehold, high netback portfolio. Okay, oil and gas. All right, oil and gas. So yeah, I mean it's going to be comparable to my BSM, except BSM as an American investor, I get better tax treatment, return on capital on the K1, and so not being a Canadian, I'm going to pay unless it's in a retirement account. I'm going to pay withholding tax on this. So potentially BSM for me works. But freehold might work for an international investor or a Canadian investor, because I believe for a Canadian investor buying like a LP in the US would be very problematic. Actually, I know that because some of the Canadians, when they were looking at there was a unique trade back in the day with, I say back in the day, it was like 2022 to 2023. There was a interesting opportunity in the energy transfer prefs. That one of the Canadian guys who actually discovered it, sadly, like he was the one who found it, he couldn't participate because of some nightmare tax reason. So I should check out Altus Base Minerals Gold Royalty. Have a gold royalty. Okay, thank you very much for that. I am going to put this on the radar of the other guys. And by the next live stream, if you ask me again, I might have a better, and we'll look at this. Altius Minerals Corporation. Okay, so it's in Canada, and it doesn't pay much of a dividend, which is awesome. That's fine. That's great, actually, because tax purposes is better. Let me go ahead and I'm putting it on my watch list right now. Okay, thank you very much for that shout out. Interesting look at it. We're going to talk about this. Let me start your question. So I got to get through all these starred questions. Thoughts on booking. I'm starting everyone's question. I'm trying not to skip. If I accidentally skip, oh, how was Spain? It was great. Okay, I think I try my best. I try my best. Leaps on oil companies. Not sure about that. maybe. Yeah. Okay. So let's go through each question again. If I skip over your question, apologies. So just ask again. Right now, I can't see the live chat. I'm going through the starred messages. So, all right. Thoughts on Novo situation with HIMS? Okay. So I was about to answer this question, and then I got a little distracted. But yes, so HIMS was never a fan of it, even though it had great performance, etc. I tend to, like I said, not like. Look at the. This is so funny. The look at the ones that it says it's related to. It's all you poll like 5 retail investors, and it's like, what stocks do you own? It's like all the same stocks. It's crazy. Palantir, Oscar, Supermicro, SoFi, all, they're all related to HIMS apparently. They're all the peer group. But it's obviously because like the people who look this up are also looking up all of these. So Google's like, you might want to also look at these. So yeah, let's compare it to Palantir. Fuck it, I'm just kidding. But anyways, yeah, so it's had stellar performance in the past 5 years or so. I personally don't. Again, I don't find it attractive. But your question was the Novo situation. So I will defer to those who will know more, and I'm going to parrot them. So I just want to clarify, this is like not my new beautiful opinion that I came up with, right? But I'm simply parroting those who I think know more than myself. And there are very serious legal issues afoot in the claims of Novo Nordisk that, if true, are very damning for HIMS, hers health. We're actually going to have a guest on. I don't know exactly when, but he is a HIMS bear, and he has probably had a great prescription of events going back to the beginning. And he used to be a bull, and then he turned bear. So that might give you a clue as to who it might be. If you guys already know, but yeah, I'm excited to have him on. And he's one person that I think really gets this. So looking forward to having that chat. But parroting them and others who, again, also I consider to be very knowledgeable in the space, that if true, it's extremely damning for them, and something I'd avoid. Now, Novo
On their side, I think that on a more constructive basis, I think there's opportunity here, theoretically. I think that the product itself, Ozempic, has mind share, and the next gen maybe is promising. And so at the end of the day, they have a product portfolio that's growing at and still a very attractive clip, and you're trading at a much lower multiple after the sell-off from the hype phase. So potentially an interesting opportunity here. This is one that might be interesting to play with some sort of options overlay, or just like, holding the shares and whatever. Okay, so I'm up 20% on TTWO. Should I sell or hold? Yeah, well, TTWO is obviously going to trade. Oh, TTW. No, we need to take 2 under active. They're trading on the hype of Grand Theft Auto, and I have no idea how big this game is going to be. This game could be absolutely massive, which it looks like it's going to be. So is it a buy the rumor, sell the news sort of thing? Maybe, right? So it's really tough for me to say, to answer this question in particular, but man, all right. So Boba the dog, you ask, could you cover Pepsi and Clorox? Are they all dying? Consumer packaged goods they're not dying, but I'll give you my opinion, and I will use a popular platform that is, I guess, good for this specific purpose. By the way, if you guys are wondering, I do subscribe to like a bunch of different services. It's absolutely wild. You guys would cry. Anyways, so for this particular purpose, it's going to be good for illustrating my point. It's funny because I'm basically then paying $35 a month for like the one question I'll get on like a comparative analysis, because that's all this is good for. It's just good visualizations. You might recognize fast graphs. It's literally perfect for a comparative analysis. So we're going to look at Clorox here. And there's a lot of problems with this, because this is just taking like the average, right? But what you can see here is like this average is obviously boosted by this time period here. If I were to remove it, which that's a problem with this software versus like other services, that won't look as nice. It won't look as nice if I were to do it myself. But this is, eye candy, right? It's really easy for your eyes to track. But this period right here is obviously elevating the average multiple. And then so you should ask yourself, like, what do I pay for business? And this was the case back then. So if you were a buyer here and you saw this COVID bump, what the market is telling you here is like, what, quote unquote, do I pay for a business that's growing at bond-like levels, right? What do you pay for that? Do you treat it like a bond? The same thing is true for Procter and Gamble, right? And so all I think right now is a different question, but this is more about before. All I think the market is doing it, and the market is still not, treating Procter & Gamble like that. This is like, for me, avoid. Like, why would I buy this? You should never, ever, you are stupid if you do this. You should never treat equity like a bond, ever. Anyone who even says that, because I've heard it before, where people go like, oh, but like, it's like bond-like returns, and they're talking about a stock. Stop listening to that person. That person has no idea what they're talking about. You should never treat a stock like a bond. Stocks and bonds, different. Bonds are bonds, stocks are stocks. So when you look at a company, an equity that is giving you earnings growth practically equal to bonds, barely beating inflation, or maybe not even beating inflation, that's not an attractive proposition. And I think that's what happened to a lot of these consumer staples, that for a while, the market in a low inflation environment was willing to elevate the multiple, what they're willing to pay, because for the consistency, right, of those earnings and the low inflation, the delta between that earnings growth, what they're able to pass on to the consumer, et cetera, versus what the depreciation and the value of the money was enough or sufficient enough to warrant some elevated multiple. And that's what the market wanted. Now that's sort of changed on itself. So now the growth is fairly anemic. Clorox is a little bit better. Clorox is at a better growth prospects than something like a Procter and Gamble. Now, that doesn't take away from their stability, but at the end of the day, the truth remains that the growth, the bottom line growth here in these companies just isn't that attractive. And if you're talking about, like there's a couple theories as far as like what rates do to valuations of particular stocks. So these dividend payers, right? They think that they're more tied, or the staples are more tied to where interest rates are. So in a low interest rate environment, which we had over the last decade, you deserve a higher multiple. A higher interest rate environment, you deserve a lower multiple. So that somewhat coincides here with what you saw with the movement of the stock. So rates were really low in 2020 and 2021, and subsequently you saw peak valuation in a lot of the consumer staples. And then after you saw rates starting to rise, that multiple starts to contract precipitously back down to where it sits now at 17. And some of you might argue that's fairly rich for a company that might be growing low single digits. Potentially, you might consider that to be the case. So then PepsiCo over here as well. This is one that, it's talked about by a lot of the dividend investors. Again, using this for just its comparative analysis, looking back in the past, it's now back down to a level where I think this one is the closer of the ones we've seen so far to its quote unquote fair value. Now, there's a lot of CapEx involved here right now, or the company has its free cash flow figure, last I checked, was a little bit misleading. So it looks a lot worse than it is. And that's partially due to some changes in net working capital and the CapEx that they're currently undergoing in some of their facilities. They're closing some of the facilities in southwestern United States. So this restructuring isn't going to be forever. There's going to be a stop to it, and then you're going to see probably free cash flow recover. So I'm not in the camp of the dividends at risk, guys. The dividends at risk. No, I think that the dividend's probably safe. What growth are you going to get is what you should pay attention to. And when, shout out to Emperor Sauron. I think he may or may not be in the chat, but we've had conversation about this a lot now, and his point is valid. Very, very interesting perspective I'm going to share with you guys here. So it's like BTI occupies a similar bucket, right, as something like a PepsiCo. It's a consumer staple, and it's growing about the same. And you could have bought it at 5 times earnings, which he did, by the way. So, it's like, he's not just saying that, he actually did. I'm going to say this because, just to pat him on the back. And for those club members who know him, you know how heavy he went. He put 50% of his portfolio at roughly the 30s and low 30s and around 28. He got BTI up to 50% of his portfolio. He's having a killer 2024 and a killer 2025 so far. So high conviction investor for BTI there, and his thesis has been pretty consistent the whole way through. So it was beautifully simple, in fact. And sometimes you don't need that much of a complex thesis, by the way, for it to work out. But while I've criticized BTI as far as like capital allocation goes, like, because they could be a lot better, I won't get into that because that will take us too off topic. But this is an example for your question, right? For the consumer staples, your alternative, like I could buy Pepsi growing at about the same rate as BTI, and BTI is trading at a much more discounted level. And the only difference is like one is a sin stock and the other one's sin stock in a different way. It'll make you fat, and the other one will remember, for smoking, most people die of a heart attack, and I guess for obesity, most people die of a heart attack. So maybe they're a little closer to each other, but one is obviously worse than the other. I'm not going to equate the two. So yeah, that's my take real quick on those. Anything change on the data center thesis? So no, it has not. So if we look at the pinnacle of, or like the one of the blue chips, we'll do Arista and Nvidia. So Nvidia is killing it. It's continuing to show the doubters, that I count somewhat myself among them as a skeptic, wrong, that the custom silicon, not a threat. There's so much demand. And then my largest player in this, TSM, TSM's actually, TSM's outperforming them all today. Look at that. Look at that. Look at that. A little proud right there. But yeah. So TSM, the picks and shovels of the whole thing, they're continuing to show really strong growth. They don't care where the silicon comes from, only that it comes. Like the overall thesis, no, it has not changed. In fact, Evercore came out with a note, I believe Monday, talking about Arista and then cross-referencing the growth capex they're seeing from the hyperscalers after those discussions, and they're more bullish than ever on Arista Networks, but by proxy everyone else. So it's not just Arista; it's the whole cohort in my view. So yeah, nothing's changed there. We see no slowdown. It's an arms race. You can't afford to not invest in your hyperscaler infra. So. You see, looking at Amazon, some potential. Okay, so I'm starting your questions, going through. I'll answer this one super quick. Yes, I'm going to work on that later after this live stream. I'll hop on voice chat and we can, and talk it through because I'm not there. Fat people want skinny. Heck yes. Okay, I see a question here. Okay, now I'm going to go back to this. Okay, I need to unstar the ones I've already answered so I don't get insane. All right, so that. All right, so Fabi, do you still like VF Corp sitting at 1150, looking juicy? So, in the club, I update my portfolio quite regularly. It's now at a once a month cadence, but I actually sold VF Corp, and I got actually quite lucky with the sell. But with the price at $11.69, it is back to more interesting level. I don't have the desire to build a position here because there's other things I'm really attracted to right now as far as building position goes. But our analyst Andrew, he actually has been adding to his leaps, so he still has a position, and yeah, he's been building his position a bit more. So right before earnings is when I closed. It was closely after the last video where we did the pitch actually. But it was not because I thought anything was wrong with VF Corp. It was just simply there was an opportunity I needed capital for. And oftentimes in the portfolio, it's a beauty contest. So if there's something that I like a little bit more, I got to go through my holdings one by one and say, what's a lower conviction and sort of sell it. And VF Corp was too small. So it got cut. But I don't really have any freed up capital to buy the idea, even though I think the idea could work out. But I'm speaking on behalf of Andrew, where he'd probably say, because he recently announced his newest purchase. So I'll share that with you by saying it appears as though he's actually still bullish and adding to his conviction, but not by like a crazy amount, to be clear. Okay, I see thoughts on Max 7. All right. I'm going back and forth, just trying to make sure I catch all your questions. And then thoughts on, we already did this one. Okay. So yeah, just to reiterate, but just in case anyone new listening, so why are CPGs doing poorly? I think it has everything to do with interest rates on a relative valuation. And if you look at how they were doing during a low interest rate environment, you get elevated multiple. Higher interest rate environment, you get a depressed multiple. I think that's what it's going to be really tied down to, because unfortunately, people are tying it to interest rates. And I would personally prefer, like, for example, PepsiCo. If you want like a generational, amazing meta moment opportunity, you probably want to buy it at like single digits PE, if I'm being honest. Will you get that? No, because there is a premium that the market has assigned for a while, and it's no. But that's like your how do you say lack of safety? It's like a lack of safety built in, because if that ever falls away, for example, like a BTI. So BTI, their cash flows have been and will always pretty much be for the foreseeable future pretty secure, but the multiple was willing to sell it to you at 5 times earnings. Explain that to me, right? So that's like your risk, is that Pepsi is one day perceived in the same vanity as BTI, or in the same group as BTI. So right now you have this difference, and that's a part of the premium that you get for PepsiCo. That premium there, if anyone says to you that is like permanent, no, they don't know what they're talking about. That premium is definitely not permanent. So that's like your lack of margin of safety. It's the reverse. For BTI, it's your margin of safety was that resurgence back to something more normal. But yeah, for those, it's going to be tied to rates. All right, let me remove that. Litigation, finance companies. I'm sorry, but I don't have a fleshed out opinion on these, unfortunately. But there is one in the UK that everyone's like in love with, but it's not something I'm into. Dr. Altina shouting out once more to be OP. Capital mindset, visit chemical. Yes. So chemical companies. So LYB, all these guys, I mean, they're trading at really depressed levels, relative to their historical valuations. The earnings are suppressed, so they look expensive. This is typically the time you want to start to buy cyclicals. So LYB, Dow Chemical, CE has so much debt, but that one has probably the most potential if the turnaround actually sticks. There's quite a few. DD is going to be probably the quote unquote blue chip safer play in a lot of the growthier, more attractive industries. But yeah, LYB, Dow Chemical, something to keep in mind. I think you're on the right track here. Booking, I like Booking. I think it's a little on the expensive side though, but very high quality company. Okay, you see Booking and Amazon some potential, or would you sell out of Booking to have bigger Amazon position? Okay, so I'm still of the belief that Amazon has so much untapped potential and has so many growth verticals in front of it. Booking, by contrast, I think that market still has legs because, okay, so why does it still have legs? Because there's so much of the world that still has yet to travel. So when you break down the global cohort of income, the United States is at the very, very, very top, along with many EU countries. So that's like the very top, and Asian countries as well. I don't want to exclude them. Asian countries and Australia. Yeah, New Zealand there too. But like that's like the Western world. Let's just say it that way. The Western world, easier to do that, is at the top echelon of wealth. And that implies like the majority of the world is still very poor by comparison. So technically speaking, all of that, as far as like the far future, is benefits or potential for a company like Booking to grow. Why? Because like maybe over time, other economies with large populations are going to start to get wealthier and wealthier and wealthier. And then those people are going to say, I want to go to this place. I want to go to that place. I want to go to that place. And then if Booking is able to capitalize on that, that's still, the runway that they have. Now, which one has the more current direct runway? I think Amazon has a really good runway ahead of it, and it's going to be less cyclical. The retail side is more cyclical, but the retail side is not as important. Cloud is almost like a steady state level of growth. So Amazon has the strength it has on advertising, which is tied to retail, right? But those two businesses, really good to be in. They're dominant in both. And then you have cloud, which is servicing all of the hyper compute needs, AI, etc. And that probably is still this strong untapped potential that when I was talking to one of the guys who's more specialized in hyperscalers in particular, he made the case that hyperscalers have still like 17+%, maybe closer to 20% rates of growth for the foreseeable future. So that should be quite exciting. And if you look at the pipelines for each of them, there's still actually quite a bit out there yet to be deployed, and there's still so much demand and not enough supply. So it's a tough call, but for me, just because where I'm coming from, I'm more excited about Amazon than I am Booking. But both are good businesses. So it's really tough to sit here and say to you, oh, it's probably a good idea to sell Booking. Yeah, I apologize. It's not a clear answer because I would be hesitant to sell Booking. It's still a very good business. Okay, so thoughts on Pfizer, Pepsi, and Diageo. Wow, completely. I like it's completely different kinds of companies. So let's go with the first one, Pfizer. This one's gonna be very fast review for me because I'm just gonna tell you. Like I'll tell you when I have an opinion. I'll tell you when I don't have an opinion. I don't have an opinion here. Why? I don't know anything about their pipeline. I am not the right person to ask. So often I will try to go within my network of people who may be more familiar with the pipeline, and I'll start there because I can sit here and do all this like, discounted cash flow. Oh, like the PE is low and the PE should be here. That's all bullshit. Right? If you need to start with the pipeline, you may in particular may be better suited than me. I don't know what your background is, but if you are, start there and then go from there. But I can't help you because I have no idea about their pipeline. I have no idea, no understanding. I can tell you, just an outsider looking in, they fumbled the bag here. They made all this COVID money and they just like spent it all. It's like all gone now. So And then on Pepsi, I think Pepsi's getting more interesting. I think for like your generational buy opportunity, like I said earlier, you want single digits, multiple. I'm not of the belief that the dividend's at risk. That's not me. That's not where I stand. But I think here it's like it's an okay, investment. It's an okay investment. I think you could probably add a little bit, and then if you see better prices in the future, add more into it. There's all this fear about Ozempic changing behaviors, etc. All right, thoughts on the Mag 7. So constructively on the Mag 7, I'm constructively bullish, but cautious on a few names in that Mag 7. So Nvidia is kicking butt, still looks like it's going to kick butt. No end of demand in sight. I'm too scared of third party silicon that one day the hot potato, I won't know when the hot potato to pass it on. So it makes me a little worried there. So Nvidia, I would participate only in trades. Tesla, forget about it. Not interested in Tesla whatsoever. I think the valuation is absolutely asinine. And that's one of the biggest retail stocks ever, to the point where, it's like everyone forgot the phrase be greedy when others are fearful when others are greedy. Everyone's greedy on Tesla. And well, there's like the Tesla Q guys that I think take it way too far, because I've owned Teslas in the past. I'm a happy owner of Tesla. Not anymore, but I actually switched it back to a gas car. For more of a fun, car. But I like the product. There's nothing wrong with the product. I'm not gonna sit here and say, oh, harumph, Tesla is a terrible product. No, that's a good product. But the valuation, I cannot get behind it. And then the rest of the Mag 7, I'm constructively bullish on Microsoft. They still have way more room to run for the business as far as that goes. Lots of pricing power. Their cloud is excellent. Their cloud offering is excellent. On its own. And then I don't think it's as good maybe as like Google Cloud or Amazon. And then I just came out with a video on Google. You can watch it. I tried to be very balanced on it. And so I recommend you watch that video. But yeah, you can get my more clear thoughts, as well as like a bit of an evaluation on it and seeing like what prices are interesting for Google. But Amazon, I'm very bullish on. And the Meta, I think everyone always just doubts Zuckerberg. Now, obviously I'm biased. Like Meta was probably one of the most boosts to my net worth in like the last 5 years or so. And, so I'll say, like, I think people slept on Zuckerberg and now have realized how good of a manager he is. I think he still will always continue to just surprise expectations. So constructively on all the Mag 7, optimistic. Tesla, not so much. Nvidia, kind of begrudgingly skeptical is my description of that. Okay, whoa, we have a lot of questions that came in. Oh, I almost forgot Diageo on the other question. Oops. All right, so Diageo, liquor. No, I'm actually looking at those less talked about European luxury names. There's a lot of European gems out there. You got to look for them. Remy is one I'm looking at closely. Diageo has an interesting product portfolio, but similar to like the other question of like in consumer staples, what do I pay for? Yeah, I didn't mention Apple on purpose, dude. Fuck Apple. I'm kidding. Apple's a good business. Didn't even mention Apple. I'm dead. But yeah, so onto the particular question pertaining to Diageo. No, I'm not too interested in Diageo. I need a lower multiple for that one too. Diageo, it traded at a premium. They're the acquisitor. I like their beer product, even though I personally don't really drink alcohol. I drink less and less alcohol as I get older, to be honest. And I know my generation doesn't really drink alcohol at all. So that's a bit of a problem for them. So for me, honestly, for alcohol businesses, there's Brown-Forman, which is, I think, a bit higher quality than Diageo. There's Remy, which I'm actually the most interested in. And there's a few other European ones that I find interesting. I probably would expect to focus heavily on the luxury aspect of alcohol. But yeah. Okay. Oh, we got some more questions, dude. I love this. You guys keep it up. Keep it up. Love questions. You guys, if you guys can basically abuse me to the point of I can just stay on here talking forever. It's not okay. taking advantage of my stock autism. About to sue him into the Stone Age. I agree as well. So that's like what all the people who know more than me. Okay, hello live stream. Hello. Oh, let's talk about Adobe. Cool. All right, so Adobe. So I think so. I'm gonna say that I do think so. All right, so but I want to try to be like constructive on both sides here. I might actually end up doing a video because I think there's another battleground stock that's just interesting. But Adobe, I am not of the opinion that Adobe is gone or dead. In fact, I'm going to make a stereotype here or a claim that based off your profile picture, you like to take pictures. I think that's a fair guess. Okay. Based off the profile picture, you like to take pictures. So you may be fairly familiar with Adobe products. And so where I'm going with this is people who are in the professional sphere of creativity, they are entrenched in Adobe. Adobe dominates that. There's no threat whatsoever. And so what I told the members when I covered Adobe in the past is like, the question is not about the professional market. The professional market, they have that in the bag. There is no question about their dominance. The question is on the amateur market. I am that customer. I am the amateur market. I was supposed to be their growth vertical. And you know what? Bad on me because I still pay for Adobe Premiere even though I never use it. So I am the perfect customer for them. Actually, I am the guy that subscribes but isn't like too like, oh, I got a nickel and dime everything, and I'm like, oh, I'm just paying like $20 a month on something that I never use. Saying that out loud, I'm gonna be like, oh, I'm gonna go cancel it. But there is that like one time where I want to use it and I have it, and I'm like, okay, cool. But it's basically like an expensive meme tool that I use to create memes here and there. For fun. So, you know, I'm paying like what is that? Over $200 a year or however much I pay. I forget how much it costs now. They probably raised the price on me. I don't even know. So, yeah, for the most part, like the amateur market growth in that sphere is becoming more difficult because you have other alternative products that are either free, that are just good enough for what the amateur wants to do, and or cheaper ones that are, again, are just good enough or simpler to use, by the way, for the amateur market. But none of the products or tools are as good as what the pro market needs. So I think like the professional market, Adobe's going to continue to dominate. So then it's a question of, when you model this out, can it make sense without the amateur market? The answer is yes. Then, hey, you know, full steam ahead. You got a massive buyback yield, very predictable cash flows. So what is not to like about Adobe? But if the valuation doesn't make sense without that growth in the amateur market, then I'd probably just wait, or it's maybe an underperform. So that you can go back in Capital Mindset, the older videos on Adobe, when, you know, everything, all of tech was sold off. You threw a rock, you hit a tech company, did good. Look at the videos I did on Adobe. I was not a fan of Adobe. And that proved to be the right instinct because it was a severe underperformer. So if you bought any of the other tech and you bought Adobe was your laggard. But yeah, thoughts on Evo. Evo needs no introduction, but love Evo. All right, so Evolution Gaming, very interesting business that I don't want to say no one talks about, because it is talked about. What I found awesome is, again, you know how I don't like to be in stocks that are heavily invested by, you know, like the YouTube crowd, the FinTwit crowd. I saw an amazing capitulation on Evo not too long ago. And oh my goodness, did it make me excited. Oh my goodness, I loved it. I was so happy. I was like, yes, there is there's so much capitulation. It's awesome. All right. But anyways, so going on a go forward basis, I feel really comfortable with this position, just knowing that it feels like we've hit peak fear. I say that and it's going to sell off some more, but and it's a funny name that I've been kind of like in and out, but I've never felt as good as I am now being invested in it, because before, the reason why I would get out of it is just because and that frustrated the guy who pitched it to me in the server. I know it did. I'm sorry, Lecker lad, but you were like, you sold Evo again, and I was like, I'm sorry, but instinctually it worked out. No, now I'm in it. I'm in it to win it with Evo. And I like that there's been that, again, just complete capitulation. A lot of the fundamentals I think are misunderstood. The growth is being impacted, self-imposed impact, similar to what we saw with Netflix back in 2022. It's not the same. Let me be very clear. It's not the same. Nothing really compares to Netflix, which is basically almost, I think it's, I'm not there at a 10x, but I won't be surprised if I'm not 10xing on my Netflix position in the next year or so. I wouldn't be surprised. Maybe 5 years. I'll be conservative. Oh yeah, I covered Dio. What would be your strategy in situation below? Okay, this one. Well, let me see this one. Diageo dead. Young people no drink, only smoke and do drugs. All right, but let's see this situation. I like this kind of question. What would be your strategy in a situation where you have a portfolio with stocks you entered almost at the top? Now they are around 1 to 2% gain. You would wait for a dipped average or just invest in all? Oh, okay. So I got you. I got exactly the article for you. You came to the right place. So this is an article put together by Charles Schwab, right? And maybe you could be, you're either investor B or investor C. Either way, you're better off than investor D. In reality, what is the most important factor is your time in the market. Assuming you're going to generate average to above average rates of return. That's the assumption. I should clarify. This is more talking about like what index funds have done, right? So this is a comparison of that. So to the exact point of your question, I will almost refer to this image. And the answer is, based off of this, you should always just be investing. If you don't need the money now, you should just be investing. If you need the money now, don't be a degenerate, right? And save that money to the side because you need it for a house you're going to buy in I don't know how many months. If it's a short-term thing, you need to have the cash, right? So that's not deployable cash. Let's separate your portfolio into deployable cash and personal finances responsible cash. I have to pay my car bill, cash. I have in excess of all my bills and savings, etc. That's your deployable cash. Your deployable cash should basically be constantly invested into the market. I can tell you for certainty, and the club members see this, like in every market, in the top of February, there are opportunities. There are things that still went up while April everything crashed. In at the bottom of things, there's a ton more, sure, but there's always something that you could, if you hunt for it, could buy it. And even if you have bad timing, so that's like more like the perfect timing camp. But even if you have bad timing, the figures show that over the long term, you'll do fine. So you should theoretically be constantly investing all excess cash and attempting to mitigate the urge to time markets. So that's my answer. Good question though. Have you had success with consumer brands other than LULU before? I really dislike stocks that just rely on selling overpriced shit. Yeah, I'll tell you straight up. I had almost success, but that doesn't count with L brands. They don't exist by that ticker anymore. They split up into a bunch of companies, Victoria's Secret, etc. But way back in the day, I did a dumpster dive investment into L Brands. I made some money. It's not like I lost money on it. I made some money, pretty practically flat. But all intents and purposes, it was a failure of an investment. Especially when you looked at what it did. I think like only 6 months after I sold. So I want to say like technically, maybe I had the right idea on it, but no, for fashion brands, aside from Hermes and LVMH in the past, but LVMH is a current investment of mine for full disclosure. No, I have not. I had the right idea behind L Brands, but no. Like for example, I couldn't see Abercrombie, Fitch. I couldn't see any of that. So what I showed earlier with Lululemon, the part that's getting me is like, what is that growth rate going to be? And I think the market is not being irrational with the multiple contracting, because you see growth rate on both bottom and top line contracting as well. Thoughts on Northrop Grumman? Thoughts on Google? I shared that. Thoughts on Northrop Grumman? Constructively positive. It's selling off today. Hope for a bigger sell off. Assets are really high barrier to entry, really strong product portfolio and pipeline. So constructively positive. Google seems undervalued compared to the other Mag 7. I would debate that with the likes of Amazon, just because Amazon looks always more expensive because people don't take into account the growth CapEx versus like maintenance CapEx. And then so like the free cash flow is actually a way higher than what it appears to be. But like on a PE basis, yeah. Meta seems to constantly surprise sell side in terms of its growth. So potentially Meta could be cheaper. And then again, Google is only the cheapest for sure if the E is correct. And that's assuming like no material deterioration in search. So like if there's, and I talk about this in the video, but basically, and I showcase some of the research, but if there's material deterioration in search, yeah, it will look like it's the most undervalued, but it won't be. But yes, like on paper right now, it looks like the most undervalued. Thoughts on Workday? Great company. I'm looking at the software space as a whole right now. My only large investment in software has been CRM, but it's kind of like at this point I call it a legacy investment. It was a product of 2022 or an investment of 2022, but at this point it's considered. I would consider it legacy. Thoughts. I am not entirely certain what happened to IAS. I don't really follow IAS. I'm not in the camp of ad tech. Supposedly, like it's trading even cheaper on a multiple basis, but I haven't kept up with it. What's the next IPO to ape? Probably that military defense contractor as soon as that IPOs. No worries. Thoughts on TMO? TMO looks interesting, actually very interesting. So a lot of healthcare has sold off, but same question as consumer staples. I'm not entirely certain like what TMO's forward growth looks like, but everything just comes down to it. That's really what everything comes down to. A high multiple means nothing if the forward growth is really high. A low multiple means nothing if the forward growth is negative, right? So everything at the end of the day comes down to, on a relative basis, what does it compare to the forward growth? That's about it. So, well, no, I had a Palantir position in my Chase U Invest account, but no, I sold it way before it got to like $100 a share. It would have been cool to grift off of that. I've showed it in the past, but it wasn't like a crazy amount of money for myself. It was basically just to keep. I have a few stocks at Chase U Invest that just keeps me status with Chase, but it's nothing material. I don't know. Not really. There's a lot of awesome opportunities right now. It's like you gotta really flash what something interesting in front of me to deviate myself from it. So yeah, I'm looking at the markets right now. They're still rallying. Geez, this market. Okay. Well, I hope everyone had a great live stream as always. If you guys enjoyed it, please feel free to leave a like, share, subscribe. If you're interested in joining the Capital Mindset Club, the link is in the description below, as well as the sponsored links. I only get sponsored by products I actually use and like, and it does support the channel if you do end up subscribing. I think there's a discount embedded in those links. All right. With that being said, I'll see you guys. Oh, Fed better cut. I'll see you guys. Your reads. I'll see you guys on the next one, and we'll leave you guys out with that beautiful outro.
We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.